Series 3, Gross Domestic Product, the GDP. I told you guys in Series 1, I will dive deeper into fundamental analysis in Series 3. So the GDP is essentially how much money an economy makes. It's the total value of goods and services produced in the country. It's measured over specific time frames like quarterly, yearly, etc. It's important to know this because it allows us to see how well each economy is doing. Leaders usually give an estimate, and if the GDP ends up doing better than the estimate, the value of the currency will rise. If the GDP ends up doing worse, the value of the currency will drop. The more goods and services produced, the better the economy is doing. It's stimulated more. So, the top three highest GDPs in the world are the United States, China, and Japan. Also, understand the difference between an emerging market and one that's already developed. So, Japan is still considered emerging. Things are still growing and developing, like, the technology, the infrastructure, etc. The United States, like us, like there's not much more we can grow. Like we're already, a dominant country. We already have the highest GDP. Like where else can we grow? We can be more dominant, but we can't grow more. Japan, I'm pretty sure their GDP like is at it was at 6%, 7%. United States is at like 23, 24%. You know what I mean? In terms of like the worldly GDP. And you know what I mean? Like when you add all of it together, it's like the United States is head and shoulders above everything else. So also know like understand if you're an importer nation, or an exporter nation, that's very important to know because if you're an exporting nation, you rely on other countries and how well they're doing for your economy to be doing well. For example, Canada, Australia, New Zealand, they are all exporting, nations. They export base metals. So they rely on countries like the United States and other countries that import their material because the more exports that they can send out and the more imports their secondary country who they're relying on can do better, the better they're doing and the higher their GDP. Now, inflation. Inflation is how much do goods cost over time. It's the rate at which an average price level of a basket of selected goods and services in an economy increase over time. So you see all the time how like, maybe, bread or eggs in 1913 cost this amount and then now in 2020 it costs this amount. Obviously over time that is inflation. It affects you in price because if you're in the US and the US is importing all of their goods, yet the performance of the economy has been dropping, you're going to be paying for more. You're going to be paying more for what you're getting because the economy is dropping. You know what I mean? If inflation gets too high, central bankers need the currency to get stronger to balance inflation. So they may try to raise interest rates, aka obviously, when the monetary policy comes out, and obviously they'll try to cut down on quantitative easing, which is printing money. They have a few tricks to cut down on inflation. So basically, like, their goal is never to have inflation too high where things are so expensive. Again, like I said in the tax, like I said, you guys will see in series 4 because I already like made these videos already. Like I do them randomly depending on how I'm feeling for the day. I already made series 4 and I talked about taxes a lot. And just like I said in there, their goal is not to have things to be too expensive or too high because that cuts down on the economic activity and the growth within the United States or within your respective country. So if inflation gets too high because like the demand of what your economy or your country is producing or they're in war or just something's going on with your country and inflation starts to get higher because it costs more to import things and production costs too much, they would try to raise interest rates. Now, basically, obviously, interest rates is basically the percentage over time you have to pay based on the loan you take out. So when interest rates are low, more people are able to borrow money because it doesn't cost that much. You know what I mean? The economy grows and inflation increases a little bit, but you know what I mean? Like it doesn't increase dramatically, like dramatically. When interest rates are high, more people start saving their money and the economy slows, and inflation decreases. So I hope you guys understand that. Like there has to be, a balance on what's going on. When the economy is slow, obviously your purchasing value increases because things are, a lot cheaper because the economy is slower. And when everything is going well in the economy, obviously it becomes a little more expensive. So your purchasing value will, decrease a little bit. But that's a good thing in a sense because that means the economy is doing well. There has to be a balance. Understand inflation can happen when there is an increase in production costs, and you'll figure out why this is important to your trading, obviously. Also, know if inflation occurs, you can expect a currency to head up because consumers will bet that the reserve will come in and balance it out by raising interest rates. The same goes for if inflation is too low. Now, if inflation does occur, that doesn't mean just get on your phone and just start to buy it, because it will have a negative effect on the currency and it'll drop down. But you can expect obviously the currency to eventually head up, because obviously the government won't let it go down, or inflation to be too high too long. Low inflation means that the demand for goods and services is lower than it should be, which slows economic growth, aka recession. That's how it occurs. Again, there has to be a balance. Overall, this has an effect on your currency pair no matter what currency pair you're trading. Make sure you stay up to date on what's going on fundamentally with the countries you're trading. You know what I mean? Because you got to understand like what's going on with countries' interest rates, and if inflation is going on or not. Look at these announcements that come out, which I explained in the next few videos as well. But you got to understand when these announcements come out and how they affect the currency, because if they affect the currency in a good way, then it shapes up that country. So let's say Great Britain, for example, if they have positive news over the course of a few weeks, on a specific date, obviously the currency will go up in comparison to whatever they're compared to. And then for the next few weeks, you should obviously stay with the trend unless it gives you a reason to start to trade back down. But fundamentals kind of shape up technicals, just like the GDP. If the GDP is coming out with their quarterly report or year, like whatever time frame you guys are on right now, see where the results end up being in comparison to the estimate. Because if they end up being higher, great, that country's currency will go up, and you can make money in this market by just simply buying that currency against whatever they're being compared to. And you can either hold it out like a swing trader, trade it intraday, or just get in and scalp it, whatever more comfortable to you. But it's beneficial to know what's going on fundamentally, because it shapes how the technicals will look. FOMC, just like we talked about, GDP in the last section, we are going to talk about monetary policy. So FOMC, the Federal Open Market Committee, is the monetary policy making body of the Federal Reserve System. You'll see an announcement on monetary policy come out about 8 times a year, especially, the United States. Monetary policy is simply the actions taken by a country's central bank to control the money supply of their country. Inflation, interest rates, make it all controlled. Each country has their own macroeconomic goals for economic growth, and monetary policy are just policies that ensure that they get there. So all it is just a bunch of people who basically set the rules and laws that make sure the United States goals get hit. That's all it really is in simpler terms. Just like we talked about in the GDP and inflation section, monetary policy manages the money supply within the country. Interest rates, controlling inflation, making sure the country is still growing. Investors, traders, analysts, basically us, we all await monetary policy reports because it allows us to determine the outcome of a specific country's currency. They have a long-lasting impact on the overall economy. So if the monetary policy comes out like one of the times out of the 8 times per year, and it comes out and it says, all right, cool, everything's going well, inflation is at this level, but interest rates are at this level, everything is kind of balanced, and we're doing better than normal, then obviously the US dollar will go up and increase against whatever they're being compared to, because that's great news for the United States as opposed to slowed economic growth. So they want to maintain low unemployment and keep inflation balanced. For the US, it's the Federal Reserve's job, aka your country's central bank, to complete these tasks. They also try to prevent bank failures by providing liquidity when there is a panic in the economy financially. So when recessions happen, they try to make sure that banks don't fail and go out of business and make sure everything's still good. Like that, like the Federal Reserve or your country's central bank is in control of everything, monetary wise. Example, if a country has a high unemployment rate, central banks will try and expand economic activity by lowering interest rates to balance out the economy, which is called expansionary, as we talked about in the GDP section. So they want more people to, borrow more money, more economic growth, more spending, more people to, go out there. Just like I said, this will boost consumer spending because lower interest rates mean more individuals and businesses can borrow money. Now, the same applies with central banks with an increased money supply, which is called contractionary, which increases the cost of living and doing business. Inflation becomes too high. In this scenario, they'd increase interest rates to manage inflation, but it will lead to a slower economy. You know what I mean? Like everything obviously is slower. Overall, stay up to date with your country's monetary policy. Just stay up to date with it. Everything will be cool. Like, you'll understand it. It'll allow you to, understand why your currency is going up, why it's going down, et cetera, et cetera. And I'm gonna go back, and I'm trying to go back, but this will simply be like the only slide that is here. So like I said, understand if they have a high unemployment rate, what central banks will try to do, what it won't try to do. You know what I mean? Like, obviously with an increased money supply, with a lot of money in there, that's going to increase the cost of living until they obviously, balance it out. When they balance it out, they obviously raise the interest rates to manage inflation. And then obviously it'll lead to a slower economy. So over time, your purchasing value will obviously, increase because, things become cheaper, over time. But when there's an increased money supply, obviously it increases the cost of living, and everything is going, everything's high at that point because there's an increased money supply, and inflation is way too high at that point. So I hope this section helped you guys out in understanding what monetary policy is. It's basically, whatever, country you're in, their central bank tries to set, a bunch of laws and regulations to, stabilize, everybody financially and keep everybody, together with a set of laws that keep, inflation balanced with, interest rates, making sure everybody's employed. They don't want you to be unemployed. They don't want you to have anything negative. They want to make sure, the country that they're representing is the best country in the world. And in order to do that, they got to make sure all the goals are getting hit. Non-farm payroll, NFP. If you've been trading for some time, you 100% already knows what that is. So, one of the most volatile news events in the currency market, NFP, is called non-farm payroll. NFP is an indicator that shows the number of paid workers in the U.S., excluding farm employees, government employees, private household employees, and nonprofit organization employees. So basically shows how many people are basically, employed and unemployed in, the United States. Regardless of the actual announcement, the US dollar has a tendency to have large rate swings due to so many different people watching this report and trying to trade it. So if the report is actually good for the currency, you may see the US dollar drop a little bit and then go up and then go down, but then all the way like long term head up by before the hour is done, because so many people are trying to trade NFP because it's the most volatile news announcement, out of all of them basically. A higher report that the estimate is good for the economy, that means people are employed, which contributes to economic growth. The opposite if the report is less than the estimate. So like every single, month, they will estimate, how many people are employed, how many people are unemployed, within the United States. If the report comes out, that more people are employed, since the last month, obviously that'll be good for the US dollar, and the US dollar will increase in comparison to other, currency pairs. And if it's, the opposite, where it's less people are employed, then it'll drop. It's released on the first Friday of every month at 8:30 a.m. and it indicates the current state of the U.S. economy. So beware of all U.S. pairs. Like I said, if unemployment is high, policymakers will try to have an expansionary monetary policy, like we talked about in the last section, by trying to stimulate the economy and lower interest rates, which allows people to borrow more money, and it balances out everything. So now people can start potentially working more jobs because inflation is not as high and interest rates are not as high. Be careful trading NFP. You can get stopped out very, very fast. You can also reach take profit very fast. So the reason why a lot of people trade NFP, because it moves so quickly. And if you're on the right side of the trade, you can make a lot of money in like 5 minutes, 10 minutes. But be careful, because you can also get stopped out and hit your stop loss very fast. A lot of times you'll have a stop loss and the market may hit your stop loss and then go in your exact direction that you predicted, and then it'll leave you all upset. There's no way around that. Understand that hedging is illegal in the United States. What I mean by that is you can't buy and sell the same currency pair. So you can't, place a buy stop above price and a sell stop above price and then trade both pairs and then cancel one out. Like, it's in the United States, it's illegal. Now, if you do it on MetaTrader, it won't say, oh, this is illegal, you can't do it. No, but obviously over time, if you get caught on your taxes, X, Y, and Z, they will either make you pay what you made, you know what I mean? Or you'll be in trouble for hedging. Like, it's not illegal in the United States. See if hedging is illegal in your own country. I just know in the US you're not allowed to technically buy and sell the exact same pair or stock at the exact same time, and then whatever it does, then just delete the other one and take the quick loss and then ride, the one that's already going up. The spread also widens during major news announcements. So you may see the spread of Euro USD be like a 6, and then during NFP maybe like a 55 or a 60 because so many people are in it, so many people are trading, and then it's a fundamental announcement. So during fundamental announcements, the spread tends to widen because so many more people are in it. The announcement is very volatile. The market is super liquid, and brokers want you to be mindful not to just try to jump in. Like if the spread is 6, anybody can jump in. But if the spread is 55 or 60, people may think twice about jumping in because that's depending on the spread times your lot size, that's a lot of money to automatically be losing just out the gate. So be mindful trading NFP. I personally don't trade NFP. I try to trade around it and try to trade Monday through Thursday. I don't really trade the first Friday of every month. I know how volatile it is. But I definitely analyze it, and I definitely make sure and watch it over and over again to make sure that I understand what's going on because NFP can set you up for the upcoming weeks. What's going on, everybody? I want to talk to you guys real quick on where to look for these fundamental announcements and what you should be looking for. So you can look anywhere, such as Bloomberg, you can look on CNBC, you can look on, Yahoo Finance, TradingView, and the articles on the right-hand side. Forex Factory is a big one for retail traders because it really simplifies everything, lets you know by color, whether it's, yellow, orange, or red, how important that announcement is. So I recommend that as well. Investopedia, there's a lot of different ways to find out, what's going on in the current market. But let's say you're on Forex Factory. You go on Forex Factory, and it has, like I said, folders there next to each and every one. What you should be looking for is what they're estimating, the exact announcement to come out as, whether it's, like I said, monetary policy with interest rates, or it's the GDP, or it's, NFP, non-farm payroll, or the FOMC is talking about, the policy making and the laws, or, the European Central Bank is talking. Like whatever news is coming out, make sure you look at what the news is, what they're estimating, the exact number to be, and then hopefully look at some articles. Bloomberg in particular, gets the actual report faster than anybody else, but Bloomberg can be very expensive, around like $20,000 a year. So it's crazy. It's worth it, but it's crazy. So I wouldn't, anybody watching this video, if you guys don't even have that, per year, don't even think about that. Forex Factory is good enough. Bloomberg is for like expert traders who got like 10 monitors and like that's their life, you know what I mean? But you can look at Forex Factory, just look at what's coming out. Let's say NFP is coming out, which is non-farm payroll, the unemployment number. And if they're estimating a certain number of people to be, unemployed, look to see what the actual number is by looking at articles potentially before the announcement comes out, because at 8:30 on the first Friday of every month, that number is there. See how it can affect your trading for the upcoming weeks in a good way or a bad way. Same with retail sales. Like everything I've said in this fundamental analysis section, you cannot skip over. Like I'm telling you, you cannot skip over because it'll hinder your trading career if you just think I need to look at charts all day and technicals, because fundamentals is what pushes the technicals. The fundamental announcement, let's say, the Federal Open Market Committee, FOMC, which is, the committee who makes up, the Federal Reserve, who like sets the laws for, monetary policy. Let's say they have one of their meetings that they have 8 times a year. They have it. They say what they're, how they feel about interest rates, inflation, and all of that extra stuff. And then that sets the tone for the United States dollar for the upcoming weeks. So you gotta, be in tune with the fundamental announcements, and you can't just skip over them. So like I said, with this whole thing in general, make sure you, mark your charts up and see where your support and resistance stuff is at. But don't just trade after that. If you're trading Euro USD, look at Euro's economy, look at the United States economy, see what announcements they have that's coming out, see how it can affect your trading if the announcements are coming this week or next week. Because chances are, if Euro USD is at a support level or a resistance level, it's waiting on a fundamental announcement to break one of those levels. So you have to incorporate fundamentals into your game. Make sure you look at one of the websites that I said in the video, and pay close attention to the chatter that can be on Twitter or the chat section on TradingView. It may not be that important, but it's still, like I said, you get the sentiment of other traders in the world and see, how they feel about, the market and the announcement that's coming out. But the real important thing is to look on one of these websites, see what announcements coming out, and see what they're estimating the number to be, whether it's GDP or, like I said, monetary policy, NFP, anything. Australia comes out with announcements all the time. Anything in general, make sure it's on par with, your technicals. If they are separated, for example, if the US dollar has been dropping dramatically and you have been ready to sell forever, or you're in a sell right now because you just think, oh, it's dropping, it's the worst thing ever. But then something happens with the US dollar that causes favor in the currency and forces it to go up. Don't just switch your bias. Like, make sure your technicals are on point. Like, if it stops at a support and then you see a doji and then a morning star, then great. Feel free to switch. But understand the market, technicals make up, the market. Fundamentals shape it, and then technicals, show it visually. What I mean by that is, technicals already know the sentiment of fundamentals already, which is what they're creating. So there's a reason why this support is right here and why it's dropping right there, because it already knows once it gets here, it's going to reverse. The market won't just get here and then reverse automatically. It'll place a doji, 2 dojis, a morning star, a hammer, and then it'll reverse up. And the market already knows what it's going to do. So you got to just react to the market, meaning make sure everything's on point. If you telling everybody that to sell USD and then it goes up, don't just switch your buy. Like, no, I'm going to buy it. You don't told everybody to sell it already, and it's already in your mind. But once it's on par, you're selling the US dollar and the fundamentals say it's going down, or vice versa, then at that point you can, feel confident in your trades and potentially up the lot size. So I hope this video helped you guys out a lot. Yo, we in the building. Swaggy C and Austin are here, and we just had a really great idea, and that idea is to surprise you guys and double up on the content and give you guys access to all the videos on the old Academy. So we've distributed the videos between, all the series based on the level of importance the video is and what series you're in. So we hope you enjoy them, and without further ado, watch the videos. I just want to teach you guys, another episode in the advanced and expert series is the wicks and the bodies. So I have this thing now where, I'm drawing the trend lines and the rays and the horizontal lines on the bodies. So glue the ray. So for right here, instead of drawing let me draw, I'll keep it there. Instead of drawing it up here on the wick, as support and resistance, which I've been doing for so long, now I'm drawing on the bodies because this is showing that price close still below here. This is still like a complete close of a candle. This is just the wicks and the fake outs and stuff, but this is our actual closes. It's showing that that's where price, couldn't get above, as opposed to a wick. You got to understand, we put a support or resistance here on the wicks. This is just where price went. This is just the lowest point price went or the highest point price went. They're just fake outs. They're not mere, places that price had to be below or had to be above. This is just the market manipulation. Whereas, if you draw on the body and you see a consecutive amount of bodies at the same time, like this, or even this, especially this one, it just shows that price cannot break above there because that is, let me take all this off. It just shows price can't break above there, and that is exactly where that support and resistance should be. You just got to be mindful of those things. So with this advanced series, we're not drawing it on the wicks no more. It just makes no sense because there's not a guarantee that the wick, it'll hit the wick every single time. As you see what here, didn't hit it, 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 hit it once, didn't hit it, didn't hit it. There's no guarantee because the wick is just a fake out. Now, if you draw on the body, there's a guarantee that, it hit it, it hit it, it hit it, close below, 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 hit it, close, all close below. So what does that tell you? It's about to go down. So this is a daily candlestick, but from 1233 to basically 1195, that is 300 pips. So gold count is different from, the regular currencies count. So I got to do another video on that as well, which I probably will do, but it's not 30 pips from 11.95 to 12.35. That's 300 pips because gold moves differently. But like I said, if you draw on the body, and then from this area you draw a rectangle to like get the wicks, then that's different. But you got the line over the body and show it's still close below. Then you got a little brief area that says, okay, price is dipping here, and then it drives. And you drive it all the way up, you drive it all the way up, drive it all the way up. Now you draw on the body again, breaks above, boom, boom, boom. Same here. Like right here, we wouldn't draw on the wicks here because this wick is still lower than the other wick. This wick is still lower than that wick. We wouldn't draw it here. We'll draw it on the body and see price can't break below this area. These are all fake outs, but price can't break below here. Now what does it do? It just pushes right back up. Like usually when that happens, when price can't break above and it's wicking a lot and it's closing below, it just drops and then it goes up. Same over here, right here. It couldn't break it, it went up, then goes down. So keep these as a modified version of support and resistance or as an advanced level, like it went up, boom, down. I don't have too many examples to show y'all. Like this is not supposed to be like a real long video. Just to tell you guys that draw your support and resistance on the bodies now, on the bodies. Like now you draw on the bodies because these are actual areas where price is closing, like with the body. Like you gotta watch the candlesticks a lot. Like these candlesticks tell the whole story. You can't look at the wicks. The wicks help us too. Don't get me wrong, because it shows where the market was pushed to. But the bodies show where price wanted to get. So when you look at, price closing above or below a certain level, like over here, like I know for me, I was waiting for 1550. So let's do this. Last week I was waiting for 1550 flat. And we can go to the weekly. And look at this. On 1550, none of the week closed below. It didn't close below. So these wicks, like if they mattered, like then it would tell you, okay, it went down here, so price should continue to follow. No, look at where the body closed. The body still closed above 1550. That just shows the market does not want to drop yet, and it can't close below this level. It wants to stay above 1550, even when it's at right now. It went below it, but it pulled all the way back up for the week at 1550 right now. Like price does not want to get in a matchup where they close below, because if they close below, they can't just close below then go back up and go. No, you can't do that with this market and close and fake out many areas. If it closes below, then it'll retest and come down. Or how it's closing above right now, what it can do is obviously, go up just a little bit, come down, retest, and boom, straight up. It's not going to close below, close above, close below. That's why it's still closing above right here. The body's just still here. So you just got to keep it on your mid level. So make sure you keep your charts clean so you can understand it a lot better. And I'll see you in the next one. All right, I'm about to tell you guys the difference between a currency, pair versus a commodity versus indice, and what pairs you should be trading, especially if you're a beginner who got this advanced package, or even if you've been trading for some time but haven't been profitable yet, what pairs you should be trading. So literally currency pair versus commodity versus indice, stock indice. So currency pairs are everything that you see. So Euro USD, that's a currency pair. Obviously GBP USD, that's a currency pair. Now I don't even remember what chart I just drew that thing on. Was it here? Was it gold? Was it AU? I have no idea. I just got to draw it again, I guess. I'm going to go Euro USD. That was stupid of me. I'm going to go to a blank chart. But just having it at its, purest form, currency pair is all the pairs that you see nowadays. So it's Euro USD, GBP USD, AUD USD, GBP AUD, like all the majors and minors. That is what classifies a currency pair. If you are, let's say, new to Forex, even if you've been trading for some time but haven't been profitable yet, haven't had any consistency yet, only trade, with currency pairs. I'm not saying these four specifically, these are just examples. Only trade with currency pairs because like the spread varies and the volatility varies, and you as a newbie or as somebody who hasn't even been profitable on a basic Euro USD 2 spread account can't be trading commodities or stock indices. You're going to blow your account. These are currency pairs. Only trade the majors and the minors, and be careful what minors you trade. Like if you're a beginner or haven't been profitable yet, as a currency pair, You should not be trading GBP/JPY. I don't care who you are. If you have not been profitable yet, do not trade GBP/JPY. This is the most volatile currency pair that, in all of Forex. If you can even figure out what Euro USD or USD CAD or a major is doing, you should not be jumping to GBP/JPY just because it moves the fastest. It'll move the fastest and it'll blow your account. Like, you got to, like I said, we're trading at an advanced level. Only trade GJ if you feel like you've been consistent enough on a small account and then you want to master GJ, but it moves too volatile for a beginner or somebody who hasn't been profitable yet to be trading. Now, if you've been profitable for some time, I don't care how little or much money it is, if you've been consistently profitable and have a proven track record, then commodities are this. Commodities classify as oil, silver, and gold. And obviously, silver and gold are more so metals than commodities, but it still classifies in the same asset as commodities. But if you look up gold just in general, I did it on gold. Perfect. Okay, cool. You look up gold just in general. This is a commodity / metal. Silver, same thing. And obviously US oil. These are all volatile, which is why gold is like 2-3 times as volatile as GJ. You know how GBP/JPY is very volatile in the Forex market? What do you think gold is? Gold is probably, 2 to 3 times what GJ is. It moves so fast. Like, it is not even funny. Like I said, from even just here to here is 1573, 1600. That is 270 pips. That'll take Euro USD and USD CAD weeks to do that, or even 7 days or 5 days, like that it took GJ, a day or 2 days to do. Like, it's insane how crazy it moves. You should not be trading gold, silver, or oil if you haven't even mastered, regular currency pairs. This is where you have to use that stepping stool. Start off on currency pairs, get a proven track record with that, move to like a minor or like some currency pair that's moves very volatile, like GJ or GA or something of the sort, and then move on from that to commodities if you want to try gold. And then from there, the most volatile of them all is the NASDAQ and the US 30, aka the Dow Jones. If you don't know what it is, let's Google it together and let's have it. I had like a silver commodity here because I'm not entirely sure, because like I know gold and silver are commodities, but I also know that like they're more metals. Like, they are 100% metals, but they're not as much commodities, which is why like it says somewhat different of an asset class. So like, it's kind of tricky. Some people don't even classify silver or gold as a commodity. I just wanted, obviously clarification, but it's 100% a metal. But I just classify it, like I said, still as somewhat of a commodity just in the Forex market. But NAS 100. You guys gotta understand what it is. People be like, oh, I trade US 30 and NAS 100. You don't even know how to trade Euro USD. Why are you trading the NAS 100? What the NAS 100 is, basically, it's a NASDAQ index covering 100 largest and most liquid companies on the NASDAQ stock exchange. Point blank, period. So the 100 most liquid and largest companies, you are trading them all in a lump sum. It's basically the same thing with US 30. It's basically the Dow Jones. What is the US 30? The Dow Jones, which is obviously the performance of the 30 largest publicly owned companies listed on the New York Stock Exchange. So all of these companies are on, obviously, the US 30. And you guys want to trade that? These are basically futures contracts. Like, you guys are trading the most volatile of them all. This is, if we go in order, currency pairs have general volatility, right? Then you got some minors like GJ, super volatile. Then you got, metals such as gold and silver, super duper volatile. And then you have US 30 and the NAS 100, which is 100% death zone volatile. Like, it's not a game. So I'm like, if you're coming into this advanced section or even into my course and you're trying to trade, US 30 or NAS 100 and you haven't even figured out how USD CAD works on a basic level, you are going to blow your account. Forex is not for you. Stop trying to chase, all the profits and getting as high as possible. Start off small. You got to build your way there. Like, I trade US 30, but barely, but I still trade it because like I've been trading for 5-6 years. I mainly have mastered gold. That is my sweet spot. That is where I love to trade. I know exactly the levels I like to move in. I know the times. I know everything about it. But don't like start off on the market and be like, oh, I'm a master US 30. You have to like figure out how regular currency pairs work and then see how a minor that works, that's basically double the volatility of a currency pair, then move to a commodity or metal, and then move to, a stock indice. But don't just rush right into it, and you will blow your account the fastest way possible. So I hope that helped you guys and give you guys some insight. Like I said, start off small and build your way up, but you should not be trading US30 or NAS 100 if you don't have a proven track record of, okay, I can trade Euro USD, or I can trade GBP AUD, or even GJ on like a small basic level. You know what I mean? And then maybe go to gold, silver, even oil. Like I said, even oil as well. And people use oil to kind of trade USD CAD because obviously, oil and Canada are positively correlated. But that's also, like I said, commodity. Like, be mindful of what you're trading. Don't just trade anything. Like Forex is not some random thing that you can just generate money whenever you want. It is a process, a step-by-step process. It's what is the word? Like, you got to have like a real good methodology, or I don't know, methodologies. I don't even know the freaking word. But you got to be very like specific on how you trade these pairs. You got to be very, very smart about how you go about it, man. Like I said, it's an art, it's a sport. It's not this random thing that you can just trade any pair and be profitable. Oh, I'm gonna jump into this market and trade US30 and make $10,000 tomorrow. You will lose your entire account. You have to understand the market at its basic level and grow from there. So I hope this video helped you guys and give you guys some insight on what to be trading and what not to be trading. And like I said, slowly and surely go up the ladder of the Forex market and the Forex currency pairs to the point where you get to a stock indice and you feel comfortable. But if you're not even comfortable trading a regular currency pair, you won't be comfortable and have your emotions in control when you're trading a stock index. So I'll see you guys on the next video. Market open, you feel what I'm saying? Like, I gotta let you guys know about market open and how, you really can, trade it, because a lot of people have this misconception that you should only start trading on Tuesday and Wednesday and Thursday as opposed to Sunday and Monday. And it really just depends. Like, some people and most people don't trade on Sundays. I don't either, as that much, but there's some times when the market looks amazing on Sundays. But before I get into that, I want to talk to you guys about gaps. So sometimes you may see that the market may close. I can go to like an actual blank GA chart. And sometimes you may see the market actually close. And you can see that, get actual rectangle. Let's say it closes like this. Let me get not an arrow. I shouldn't have an arrow, but it doesn't matter. Closes like this, right? And let's say this candle was super red. You may see when the market opens, you may think obviously because the next candlestick should open right, next to it, and then obviously next to that. The market may open way down here, randomly, out of nowhere. It could be red, it could be, blue or green, depending on what you have as a bullish candle. It could open way up here. This is called a gap, where there's a bunch of space in the market, whether it's above or below. It's called a gap. What you should know is that the market will always fill that gap back up, no matter if it's, that day, the next day, the next week. That gap will always get filled open. So for example, I know I just deleted that. Keep that there. And let's say, for instance, if the market opens, way up here, by the end of that week or the next week, or most times that day, the market will find a reason and wick all the way down here and just right to where it last stopped at, if it's above, obviously, before coming back and obviously going, up depending on where it wants to go. Because obviously, wherever it really gapped towards, it should usually continue in that direction, because that just means that the news over the weekend, pushed it in that direction. So for example, I'm gonna show you some gap pairs that immediately close as opposed to a few days later, which happens more times than not. But right here, you can see the market right here. So this is a bullish candlestick. So that means it opened down here, it closed right here. The market, it closed at 204.585. So the market closed at 204.485. Right here. The market opened, because this is obviously the bodies where it opened at, the tops, and this is a red candle, 202.974. Open at 202.974. This is why you don't hold your trades over the weekend, because obviously if you had gotten in, you're in for a buy right here. You could be up, let's say $1,000, $2,000 for the weekend. You're like, I'm just gonna hold it for another week, and you let it go on Friday. The minute the market opens Sunday, you may be down $5,000 because it dropped, over the weekend 2.02. And you may ask, how's that possible? You gotta understand, just because the market is closed doesn't mean, the government and everything else is closed. So there may be some kind of fundamental announcement like the pandemic we're on right now. Like the pandemic could have started on a Saturday, and the minute the market opens on Sunday, it has to reflect what happened over the weekend. So you got to pay attention to the news that comes out over the weekend, because the minute the market opens back up, it's going to reflect that. Now, sometimes, aka most times, the market should open up, right next to where it last left off. But a lot of times, it will gap because of the news over the weekend, which is why we will close our trades on a Friday and make sure we're not trading. Because, like I said, if you hold it over the weekend, you don't know what's going on with the gap, and you don't know if it's going to gap up or down. Like I said, the gap can work in your favor. It can bring you way more in profit, but it can also, liquidate your account and bring you all the way negative. Some people may ask why, before I get into the direction, why don't we just trade the gap? Because we don't know. Like if it opens right here, there's no guarantee that it's going to immediately close the gap. It can come all the way back down, retest, and then by the end of that day or the next day, come up, close that gap, and then continue. It does not have to close the gap that specific time. Now, what you should know is wherever it gapped towards, more times than not, it'll continue in that direction, because when it gapped here, this is telling you something happened over the weekend that has to deal with the British pound in a negative light, or the Australian dollar in a positive light, to push it down. So the fact that it opened like this on Sunday due to what happened, when it closed on Friday and Saturday, it's going to continue down. Look at the dots. Continues all the way down, all the way down, all the way down, all the way down. You know what I mean? From level to level to level to level. So obviously, every time it hits Friday, we close our trades, because we don't know if, let's say, the market closes like, right here. And we're like, oh, it's at this level. I'm going to trade it. And then we're still in the first sell. We're holding our trade from up here. And then the minute the market opens that next Sunday, it's way up here. Like this isn't a gap, but I'm saying, for example, just imagine with your brains, the market gapped up here, or it gapped way up here because of some news. So this is why we close our trades on Friday every single time. Even Euro USD gapped, I believe, recently. Yeah, right here. But again, it closed immediately. So it closed right here at 1.09785. And then it opened at 1.09659. So only a 100 pip gap, not that much. Obviously, the minute it opened, it closed the gap, touched the wick of the low of the last candlestick pair, and then it head back down. But obviously, if it gapped to the low, guess where it's going? Continuing all the way back down. So just understand that. But back to what I was really saying about the video is that you can trade when the market opens. Like, look at this move. This happened on Sunday, and it goes straight down. Like, a lot of the best moves happen on Sunday and Monday, especially with the pairs that I be trading, like GA. When I made that 5K, I made it off the gap. The gap was a Sunday, I believe. Yeah, exactly. You can look at the dates on the bottom. April 3rd, the minute you come over, April 5th. That tells you that we missed 2 days because of the market close. It did this, it bounced off this moving average, and then I got in. You know what I mean? Like I got in at like midnight, I believe, on that April 5th. So obviously it's April 6th, but you can see the GMT times 2. So it was about 2 in the morning when I got in, came down, and then we were really set. You know what I'm saying? So just understand how your currency pair moves. Be mindful, because when the market opens, the spread is insane. Like the spread may be 500, 200, 300 because the market is still finding its feet. The market, like the brokers don't want you trading the minute the market opens on Sunday. But after about an hour, hour and a half, the market should reset itself and go back to like its original spread. Still a little volatile, but go back to its original spread, and you're able to trade that Sunday or that Monday. Like most of my favorite pairs, like GA and gold, move Monday, during the Asian session. You know what I mean? Sometimes they move Sunday during the Asian session. Like a lot of my pairs move, Sunday and Monday, and Tuesday, Wednesday, Thursday, it still moves as well. You know what I mean? Like the pairs like Euro USD and USD CAD, like the majors, may not move at all Sunday and may barely move Monday, but move somewhat. But then Tuesday, Wednesday, Thursday, it's split. But the pairs I trade are, very volatile. So GA and gold will move Sunday, Monday, Tuesday, Wednesday, Thursday, Friday. They don't care. AU may wait, just like the majors, and wait for the actual days to set itself, and like the traders to actually come in, wait a few days, and be good. Remember, the reason why these pairs move up or move down is because everybody's selling it down. So there's two things. One, if there's a fundamental announcement over the weekend that'll push it down or up, then it's going to go there. Two, there's also going to be banks. Actual traders and banks and companies and firms who are also pushing it down or pushing it up. So obviously, if it's Monday, people are just getting to work. Some majors may not trade or may not fare as well on a Sunday or Monday, as opposed to these volatile pairs like gold, which doesn't really care. It moves whenever it wants. It's a safe haven currency, and GBP AUD, like I said, it's a minor, but it's one of the more volatile minors, especially with Great Britain being involved. Doesn't really follow the rules, which is relax on Sunday, Monday, then show yourself Tuesday, Wednesday, Thursday, does whatever it wants. So be mindful. Like I said, just one advice I can give, and I've been giving consistently, is know your pairs. Be mindful of the pairs you're trading, because that'll tell you everything you need to know about when it moves. Like I said, this is why you should master one pair and have another pair in the background, because I can tell you, I know GA and gold moves on Sunday or Monday. Like I know for a fact it does. I'm not too sure about Euro or USD CAD. I don't trade those pairs, but I know. So know your pairs, and then you'll be a lot better off trading. But I just wanted to give you guys a quick summary on the market open based on like specific gaps and where it's going to gap to and how you should trade potential gaps, and if you should be able to trade Sunday or Monday. There's like every day is a trading day to me. That doesn't mean I'm going to trade every day. That just means if I see a good setup on a Sunday, I'm not going to be like, oh, it's Sunday, I'm not going to trade. I see a setup, I'm going to trade. You know what I mean? So just keep that in your mind. Every day is a trading day, but every day is not a trading day. Meaning I'm not going to trade every single day, but every day is a trading day in a sense of if I see a good setup on a Friday or Sunday, I'm going to trade it. Now, if it's Friday at like 3 p.m. and the market closes in 2 hours, then no. But if I see it on like Sunday, Monday, Tuesday, Wednesday, Thursday, or even Friday morning, I'm going to take the setup. So just keep that in your mind, guys. So I'm about to break down, partial profit versus, full profit. So what you guys don't know is that, let's say, for instance, if you're obviously like a swing trader or you want to trade it from level to level, if you got in right here and your take profit was way down here, and let's say your stop loss was, right above here or right above here, right here, 1 to 13 risk reward ratio, and let's say price is going down and you're up, let's say $3,000 or $4,000. And you don't want to, wait for it to come all the way down here, or you're scared of the retracement, which obviously your chart should be black, so you shouldn't even be, looking at red candles. But if you see, price getting here and you're up 3,000 and you don't want to, let 3,000 go to waste, you can easily go on MetaTrader and take, 1,500, 2,000 of that and have that guaranteed into your account, and have that extra 1,000 that is still left run all the way down here. You can obviously move your stop loss into profit, so where your stop loss is right above here. So now it's a risk-free trade, and this is the most you'll quote-unquote lose, which is actually profit, no matter what. You may even make, $500 off that $1,000 left. So for example, let me try to get actually go to your USD and actually go right here. So let's say if you got in on Euro USD on a 4.00 lot size, right? Price drops, you're in for a sell. Let me move this over to at least. Price drops, you're in for a sell. And the good thing about it is, let's say you're up $5,000, but you have price going further, right? You have price going further. So if you have price going further, but you want to take some of that money that you have already out of that 5,000 and put it into your account, so you don't you don't waste that, go to MetaTrader, to that live trade, hold it and click close as if you're closing the trade. So close trade, and it should say, close with profit $5,000. Don't click that. What you should click is above should be your lot size of 4.00, right? So remember, if you click close, like I said, I wish I could, record it on my phone or have somebody record me doing it on the phone, but I'm just gonna do it right here for now. Above, when you click, your actual trade of you up $5,000 and you click close, not modify, but close, it'll say close with profit $5,000. Above the close with profit should be a lot size of 4.00. All you have to do is change your lot size. Let's say you want to close 2,500 of it. Change your lot size to 2.00 lot size. Immediately, it will now say close with profit 2,500 because you changed your lot size. You modified it without clicking the modify button. You click the close button. So you click close with profit $2,500, and that $2,500 will now be in your account, and the other $2,500 that's left will still be open. So this is a way to, take partial profit on a trade without, like, say for instance, if you're only in on one trade and you're not in on multiple trades, this is a way to take partial profit and still be good and still have, money left over. So you can at least, all right, worst case scenario, I made 2,500 and let's see what this rest does. So let me break the process down again. So if you're up, let's say $1,000 on Euro USD, or even gold, or any pair in general, GBP, AUD, right? You're up 1,000 and you want to close it, go to close. It'll say close with profit of $1,000. Let's say you have, I don't know, a 1.00 lot size, right? If you want to put, let's say $700 into your account, change your lot size above the close with profit to a 0.70. Because obviously if you have $1,000 and you want 700 out of that 1,000, 70%, change your lot size to a 0.70. It'll now say close with profit of $700. And now that $300 that's left over will be running still. Hope that makes sense to you guys, because it's very, very, very simple. So if you're on Euro USD and you have price, let me go to my actual Euro USD chart, and you have price going here, and let me close this. You have price going all the way down here, but you want it to close right here. You can partially close it and take, whatever amount of money and close it and guarantee it into your bank account, your trading account right now. And then whatever is left over will be still running right here. So, like I said, I hope that makes sense. Sometimes it's okay to take most times it's okay to take partial profit. I take partial profit all the time because I want to make sure that I at least get some money. Like if I'm trading to here and I know it's going to get to the level, but the minute it gets to like this mid-level, wherever the mid-level is, well, this is actually the mid-level. The minute it gets to this mid-level and I see it, coming back down, to like kind of make sure my emotions are in check and I'm good, I will close half the trade or 3/4 of the trade or even a quarter of the trade, whatever I feel comfortable with, move the rest of the trade and that stop loss into take profit, and then let the rest of that trade run, and I just guarantee 3,000, 2,000, or 1,000 into my account right now. So no matter what, I won on this trade. So make sure you start implementing, partial profits in your trading game. It is amazing. It's going to be great. It'll help you, stay above the curve and understand what's going on with the market and understand that, okay, I'm going to take some money right now and let the other trade run. It's not so you can just let your trade run forever and ever and ever. And if it reverses on you, then what happened? Like if you're up $3,000, I said this before, if you're up $3,000 on a trade and you end up losing that trade or breaking even, it is your fault for not taking partial profit or at least moving your stop loss into profit. That is your fault. The market gave you $3,000. Stop being greedy and take some of that or even all of it. But just make sure you're mindful on the difference between a partial profit and a take profit. It's okay to let your trade run all the way up here or from here all the way to that next level. If you're an intraday trader or a swing trader or you just want to hold it because you know it's going to get to the next level. But as it's going and it's making, higher lows and higher lows and higher lows, feel free to take partial profit on that original trade, scale in right here. Like I said, this is advanced stuff, bro. Like scale in right here. So it's another trade. Go right here. Another trade, move this stop loss into this profit right here, and this is a whole new trade on its own. This, we can take partial profit from this trade originally. You're in 3 trades now, and you already took partial profit on the first one, and it's coming back down. Stop loss below here for this one. Like, it's just, and scaling again. Like, it's just a constant cycle of, constant trading. Remember, like, it's a sport. It's an art. Like, make sure you, like I said, you're smart. Use all the tools you can to, like, guarantee your money because, like, money doesn't come easy in this market. If you're an expert and you've been trading for some time, yeah, but it's money. Like you worked at a 9 to 5 for so long just to get, $500 at the end of the week or $1,000 at the end of the week, and you get $1,000 in a day or $2,000 a day. You're not taking partial profit. Like you're what's wrong with yourself. You know what I mean? Your own emotions and psychology. So make sure you start taking partial profit. Don't take partial profit if it only goes like 20 pips. I'm like, oh, I'm gonna take partial profit. No, like just let it run a little bit. And if it's making higher lows and higher lows, feel free to take partial profit and let the other trades run. And like I said, I'll see you guys in the next video because this video, like I said, I hope it helps you guys because it's giving you guys some clues on, stop just being in one trade or just in 2 trades and letting it just go to your take profit. Feel free to, take partial profit and move your stop loss into profit and let the rest of that trade run. And that'll help you dramatically. Like we're in the building, another video on the Swag Academy. This video, I'm going to break down the actual pip count with gold. A lot of people, try to trade gold without knowing how it moves. And some people, are afraid of gold because they think it moves too crazy. I got to break it down to you guys right now. So this right here, the numbers right here, understand what they mean. So 1,500, let me actually go to a smaller time frame so you can see the analogy better. Price going from 1,700 to 1,690. You guys may think it's 10 pips. It is not. That is 100 pips. You've heard that correctly. That is 100 pips. So 1,700 to 1,690 is 100 pips. 1,700 to 1,680 is 200 pips. The pip value count is different on gold because it's a commodity and it's a metal. You know what I mean? So let me give you an example on Euro USD, a blank chart. Let me make it a blank chart. So for it to be 100 pips, it has to go from 1.08000 right here to 1.09000. That is 100 pips. For 200 pips, 1.08000 to 1.10000. This entire move is 2,000 pips. I mean 200 pips, not 2,000. Sorry, 200 pips here to here. On gold, it is so volatile that a move from 1680 to 1700 is 200 pips. Let me break it down on a daily time frame. So look at it from here, 1700 to 1680. This is 200 pips. This was done in one day. We're on a daily time frame. This was done in one day. I go to Euro USD for 200 pips, 1.08, so this right here, to 110, which is right here. It took 1, 2, 3, 4, 5, 6, about 6 to 7 days for a regular major currency pair to get 200 pips. It took gold one day to get 200 pips. This is 1715, 1685. So that's not even 200 pips. It's actually 300 pips. 1715, to 1685. That is, yeah, it's crazy. That's actually 300 pips because it goes from 1685 to 1695, which is 100 pips. Then 1695 to 1705, 100 pips. Then 1705 to 1715, 100 pips. Meaning 1685 to 1715, 300 pips. Gold moves so crazier than anybody else. So you may think price going from 1450 to 1700, that is, I gotta do that in my head. That is about 2,050 pips, I believe. Like, gold moves so crazy, which is why it's my favorite pair, because you gotta be like really good at trading to trade this pair. You should not be trading this pair if you're an absolute beginner because it moves too crazy. One 15-minute candlestick may blow your whole account if you have a small account, especially with all these wicks, you know what I mean? Gold is actually one of the smoother pairs. Gold has actually been shut down because of the actual coronavirus that's going on right now. So when COVID-19 ends, and I'm pretty sure it's going to end, and my Swag Academy will, withstand, obviously, the coronavirus and be here a lot longer. When people watch this video, by the time you watch this video, the coronavirus may be over. But for the people who are just joining my course or have, been on it, obviously all these wicks signal indecision. And obviously the refineries have been shut down. The refineries that have gold miners, they've been shut down, and all our brokers emailed us and say gold will have a lack of liquidity because of the gold refineries shutting down because of COVID. So all these pairs going back and forth is being really stupid, and it's not as smooth as it was. If you look back in time, gold is very smooth. Lower highs, lower lows, lower highs, lower lows, stop, reverse, consolidation, higher highs, higher lows, like respecting structure. Then Corona starts, and then all of a sudden, look at like Corona. Obviously, the pandemic started and shut the city down around early March, and then obviously we get like craziness. So I wouldn't trade gold during COVID, but when you do trade gold, when COVID ends, or if you decide you want to trade it now and you want to be risky, be mindful that gold moves ridiculous. This little consolidation right here, from here, 1748 to 1658, that is about 990 pips, I believe. And that's just off the top of my head, because I know 1748 to 1648 is 1,000 pips. So obviously 10 up would be 900 or 990, one or the other, but it's around 900 pips. Like, that is insane. Remember, Euro USD and pairs like that, and USD CAD and stuff like that, regular majors and minors, 140 to 141. And USD CAD has been crazy lately, but 138 to 140, this right here is 200 pips. Gold can do that in an hour, 4 hours. Like, gold does not respect anybody, which is why I'm able to make the profits I make. Because once you master gold, you can become a millionaire. Like, you really can become a millionaire, but you got to be mindful and patient of your account size. So that is how you trade gold, and that is the pip count on gold. Understand, these moves, 1,500 to 1,520, is not 20 pips. That is 200 pips. On a currency pair, if it does that, it'll be 20 pips. So I hope that explains it, easier for you guys. Be mindful when you're trading gold because the pip count is different. I'll holler at you guys on the next video. All right, we're back with another video. All right, so we're gonna talk about lot sizes and appropriate lot sizes for your account. Depending on what account size you have, a lot of people blow their accounts because they over risk. A lot of people are worried about money entirely too much, as opposed to wondering and worrying about being the best trader they can be and in the world. So this is how it should be in general. So depending on if you got in for a buy, because obviously structure, low, high, higher low, higher high, higher low. Obviously, hopefully this will make a higher high. If you were to get in for this buy right here, your stop loss has to be below this low. This is the last low that price made. 1, 2, double bottom. So we'll have it a few pips below, right? Cool. You have to measure how much you potentially would lose if the trade goes bad. I don't care how much money you want to make. Always factor in how much you lose. That's the most important part. So you get in, let's say price was here, 0.64314. Let's just say 0.64300. This is your stop loss, 0.64118. Let's just say 0.64100. That is a 20 pip stop loss. So lot size management. So if you were to use a 1.00 standard lot for a 20 pip, you would lose $200. So this trade right here, again, is a loss of $200. You have to factor in if you can afford to lose that. I don't care if, this gain, let's say for instance, 64300 to, 64200. That is 90 pips. When you become obviously when you trade for a long time, you can do that all in your head, but 90 pips. So 90 pips times that same standard lot size, 1.00, that is $900. Which makes it an obviously 1 to 4 point something, 1 to 4.5 risk to reward ratio. I don't care if this is promising and this looks like, if this goes all the way up, I'll make $900. You have to factor this in, because if you have a $500 account and price for some reason heads down and stops you out, that $500 account just turned to $300 and you just lost maybe 40% of your account. And the goal is to never risk more than 2, 3, 4, 5%. You know what I mean? You have to be mindful of this, which is why, I don't care if you got to start off small with small lot sizes. Be mindful of your account. The goal is not to blow an account, and the goal is also not to flip an account. It's not to take a $100 account to $10,000 in 5 days. That's not the goal, because you're going to end up over leveraging and end up losing, a lot more than you intended to. So, in cases like that, lower down the lot sizes. If you use a 0.50 for 20 pips, this loss would be $100. And I'll delete that as well. And this loss would be, 90 pips, so about $450. Again, like I said, I don't care how much this looks good. If this is too much for you, don't risk it. If it's not too much, cool, trade it. And then the good thing about it is the goal is for price to come up, come down a little bit, and the goal is not for you. Like I said, you got to be in control of your emotions, because the minute you see it going down, you may close your trade thinking, I'm about to lose $100. You should not be panicking. If losing this $100 will make you panic, you shouldn't be using a 0.50 lot size. Lower it down, 0.25. You got to get to a point where if price hits your stop loss, you're like, it's okay. There'll be a better trade tomorrow or later today or in the future. I just messed this trade up, and then write it in your trading journal, what went wrong, what you didn't see, and move on. It shouldn't be like, oh my gosh, I'm about to lose this money. Let me get out before I lose $100. The goal of your stop loss is to be there. So you don't care. The goal is never to lose, but if you lose, it's okay. That is what your stop loss is there for. This is the absolute, maximum I want to risk and lose. And if I lose $100, it's not the end of the world. If it is the end of the world, lower your lot size. I don't care if you're making pennies or using a 0.05 lot size, lower the lot size. But back to my point, the goal is for price to come up, come down, and then shoot up again, and then come down. And then obviously you can take this stop loss. It won't let me do it here specifically, but on MetaTrader you can put this stop loss right here in profit. So now price comes back down. It is a break-even trade, and it's risk-free. And then come back down, and then comes back up. Obviously higher highs, higher lows, no structure. And then this stop loss that I got put right here gets placed right here. So now your stop loss is in profit. And then again, obviously it made this higher low. Your stop loss is in profit again, constantly, over and over, repetition. So this $100 you potentially going to lose, now you're about to make 200 or 300 if price comes back down and stops you out here or here. That is the goal, to move your stop loss and profit when structure creates and continues with itself. Now, to not get scared, remember what I said in another video, the black charts video, to not get scared at all when price is making its retracements, because you got to be mindful. Price will always make retracements. It's always going to make higher highs and higher lows, no matter what. It's never going to go straight up. It is going to make higher highs and higher lows. So you don't get scared. What do? Like I said, turn your charts black. Not worried about it. So now you see a bunch of black candles, and you're like, okay, cool structure, and it's going up. You're not worried about it. So, like I said, be mindful of, like I said, how much you can lose. The goal is to preserve your capital. Make more money, but to preserve the capital you put in there. The goal isn't to blow an account. I blew several accounts in my first year because I was stupid and rushing, wasn't patient. And I'm trying to shorten that learning curve for you guys. Like, there's no rush. You got to be mindful that the market existed way before you lived, and chances are it existed before your parents even lived. And you just found out about it last month or a few weeks ago or a few months ago or even a year ago. Point I'm trying to make is you just found out about it. So you taking an extra month or 2 months to like fully study and practice and get to understand your strategy and your emotions. Do that. It's not like you're going to miss out on money, because the minute you jump back in the market, there's money to be made. Like you forgot about the market and wasn't trading for the last 10 years. People were making money. You jumped in now, and now that you know that there's so much money in this market, you're like so ready to make money as soon as possible, make the most you can make, and you have to relax because you're going to do a lot more harm to yourself than positive, than good. So, be mindful of what you're risking. Like I said, just be mindful of what you're doing. There's no right answer on what lot size you should use or not use. The only right answer is you shouldn't risk too much. Like, once you become good and great on the market, you can be aggressive and maybe risk 10% if you're confident in your skills. But they always say never risk more than 2 to 5% of your account. Like, all investors say that. And sometimes in this market, it calls to be aggressive, where you may got to risk a little bit more because you're so confident and so positive. But more times than not, just be patient. Always, always, always factor in how much you could possibly lose first before you factor in how much you could make. Once you do that, you're golden, you're good. Keep your risk to reward ratio 1 to 3. And that is appropriate. Like, nobody can tell you what's an appropriate lot size. Just make sure you don't risk a lot of money and over leverage and use, risk more than 10 to 15% of your account. Then it's like a few bad trades and you're done. You know what I mean? So the goal is never to do that. The goal is to keep that risk low, keep the reward high, obviously 1 to 3, 1 to 4, 1 to 5, 1 to 6 risk to reward ratio, and go from there. I don't know if you have a $500 account, 1,000, 2,000, 10,000, 5,000, 500, 200, but whatever it is, before you place that trade, find your stop loss, the last lower high or the last higher low, place it there, measure out the pips, and then multiply that by potential lot size, and then that is your lot size. That is your lot size, basically. So, obviously, when you make a trade, this is what you should do. Find your stop loss, measure the pips from entry to stop loss, and then see if you're comfortable losing that much. Obviously, with the lot size. Once you do that, the minute you get comfortable with that loss, use that lot size. Point blank, period. I use this is why I work on my sniper entry, so I can have like the lowest risk possible, so I can enter right here and then stop loss right here, and I can use a 5 lot, 7 lot, 8 lot, 6 lot, 10 lot, because it's like, okay, the worst that can happen is I can lose $1,000, but I may make 10,000 or 12,000 because I worked on my entries. And that is another video I'll make that you guys can watch after this, or somewhere in between, your entries, because that's very, 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 very important. Your entries, because the better your entry is, the better your stop loss is, and the higher your lot size can be. But if you try to enter right here and your stop loss got to be down here, that's already 30 pips. Or if you go to GA and you enter for a sell way down here, your stop loss got to be way up here. That is 1938. I'll just say 865 to, that is already 100 pips. You got to have a 100 pip stop loss. So if you put a standard lot size, you're going to lose $1,000 potentially to make this. You got to be mindful of your entries, and we'll talk about that another time. But right now, like I said, back to my AUD USD chart. It should be here. I don't know where my text went. I can't find it, but it's okay. Like I said, measure out your entry to your stop loss, and then figure out if you're comfortable losing that much. And if you are, use that lot size. So I hope that video helped you guys to like kind of figure out what lot size to use. There's no right answer. The only thing is preserve your capital. You're not here to blow an account. You're here to live off of it. So I'll see you guys in the next video. Very quick video. I just want to like let you guys know how to trade consolidation. I did this earlier in the technical analysis section, identifying a trend part 2 in consolidation. But I want to make it a part 2, but keep it in the intermediate levels and how to actually trade it. When you see consolidation, don't think that, you know, the right thing to do is to, you know, obviously, first of all, you drop from the top of here to the bottom of this one and just drag it over. That's it. Just draw to the bottom of like one of the closest ones and drag it over. You don't want to trade up here because it's not guaranteed. You don't want to sell and buy down here, sell down here, back and forth. They're gonna like it's too much spread and commission you're gonna lose to, you know, your broker fees and all that stuff by entering and exiting so much. And then on top of that, like you never really know what the true trend is because you didn't wait. Now, how to trade it is, like I said before, you wait for the breakout and the retest, and then you get in. It broke out here. It retested this moving average and created like a little mini consolidation right here of its own. But it, boom, tap, 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 tap. It showed that it could not go back in here. Basically, 1, 2, 3, 4 hits to the top and a little mini misses right here. Then on top of that, it goes below the moving average and boom, creates a high wick. Doesn't create any big wicks over here except for down here, but creates a high wick right here. It's easy to place a trend line and wait for price to break below. Break below the body. Close below. This is a daily candlestick, so obviously you wouldn't wait the whole day. You just get onto a 15-minute or an hour and wait for that hour to close below. Because these didn't close below, but these are daily candles. But go to the 15-minute chart, and I don't want to, I can scale down actually. Let me see. This is October. This is July 18. Let's go to a 4-hour chart. Actually, 1 hour. July 18, July 18, July 18. And we're in November. This is why I don't want to scale down because it's an hour chart so far back. But let's see. July. That's in July 18, right? Yeah, July 18. So it's way back here. Right here. Okay. Right here. Boom. We see this. When I seen this on a 1 hour come down, then a little mini consolidation and break through and a retest right here or the moving average, I would have got him right there. Boom. Easily. Rolled it all the way down. Basically what you do with consolidation. You see what you see on like a daily or 4 hour, scale down to a 15-minute or 1 hour and enter. And then your stop loss obviously is right here above the last swing high in the box. And it's like this. Take profit would have probably been right here, maybe. Last area it went to before heading back up. So probably would have matched it right there, and obviously price went straight down there. It's still a 1 to 1.4 risk to reward ratio. Great, cool, boom. On to the next. Same over here. Perfect. Same over here. Draw a box. Just circle. Price. Boom. Up, down, up, down, up, down. Price finally breaks through. Big ass shooting star, aka Maribozu, like one of the same, but big ass candle momentum. Comes back in to retest the moving average and the box and breaks below. Your entry is right there. Right there. That is your entry. Okay, flawless entry. Enter right here. Price goes down. Comes back up to retest your entry. Goes a little bit negative. But your stop loss is still up here. And then boom, drops like it should have. Entry right there. Stop loss right there. Take profit if I backed up. Oh, the psychological areas. 175 would be my stop loss. I take profit because it's a psychological area. 180, 175, 170. Boom. Price clearly got down here. Went a little bit lower than that, but I ought to be fine with just my take profit right there and then head it back up. Understand that. Consolidation is how you trade it. You wait for it to break out. Don't trade the consolidation. Wait for it to break out and retest. Once it breaks out and retest, trade the continuation candle. Go like that. Boom. Simple as that. Same with over. Is another one, or you can do this all day. Even there, right there. Like this is like consolidation. Trading consolidation is really easy. Like you place it around the box. You place a box on it. Look what it does. Price fake out right here because it comes back to retest and comes all the way back in. Never comes back out. Like
breakthrough, retest, continuation. Doesn't do that. Breaks through, fake out, comes back in. This is a real breakout. Now, what you would have done, since it's a daily candlestick, even over here, what you would have done is you would have went back to the 15-minute chart or 1 hour and see why, if price would have retested, continued, or broke back in here. Same way here. You don't see it on the daily because it's so tight, but I can see that little wick down there that shows a retest, which means on a 1 hour, 15-minute, this price came up, retested, and pulled back up. And if you want me to show you, I will. March 18th. It's going to be a long time, but let's see it. March 18th, March 18th. March 18th, March 18th. I need you here, March 18th. We are in, we're in December. Okay, bear with me, almost there. I'm gonna show you guys that the strategy is real, man. It's real. Right here, March 18th. What it does, clear as day. Breakout. On a daily, it looks bigger, but on a 1 hour, it looks smaller. Breakout, retested these little tweezer bottoms right here, another candlestick pattern, and then goes up. So not only did we get, if I can go back to March 18th, which would be perfect. Not only did we get, momentum candle, not only did we go above the moving average, not only did we get any of those things, on the 1 hour, it shows we had a tweezer bottom, which is a Japanese candlestick, a reversal to head to the upside, as a retest. Boom, that's an easy entry. Would have got in, or long, got in right here. Take profit would have been, I wouldn't have put the take profit at 180. I wouldn't have. You know what I mean? It would have been too small for the risk reward. My take profit would have been 185, only because that's the next psychological level. It's 180, 185, 190. You could have a 182, 500 like a midpoint. That would have been fine too. Honestly, I wouldn't have been mad at that either way. A take profit right here, 182, 500. Would not have been mad because, like I said, price got there and then retraced a little bit and then pushed up. So either or. But like I said, go to the advanced section, after you're finished with all the immediate, and you'll understand why I have these psychological levels and what they really mean, the bank levels and how they trade at these levels. But that's how you trade consolidation. It's not that hard. Don't trade the consolidation. Wait for it to break through, retest, and continue, and then trade it. You should be very profitable, or at least be comfortable with what the trade does, no matter what. This is another part of the psychology section, but you gotta have a clear trading plan, so you know what you're willing to allow and not allow from yourself in the market. What I mean by that is you gotta say, okay, like, you can write this in your notes section on your phone somewhere. You could say, I will only trade if price reverses. Let's right here. Price reverses at a key level. Price bounces off the moving average. Candlestick formation. What else is good to read? Candlestick formation. Fibonacci. Like anything that you could think of that'll help you, get in the market. That you usually do, like you'll only get in if you see 3 of these things or 2 of these things. That's it. You never want to get in if you only see 1. But you should only get in, like I said, with your trading plan. Like depends on what helps you trade, like fundamental analysis, even the news. Like you can say, okay, if the news is this or coming out this day, then I'm only gonna trade if I see this. Like I don't trade the news, and I don't think you should, but I'm just saying people are different. You should have like a set level of rules in here that says I'm only trading if this happens, if that happens, And once you do that, it gives you more of a sense of calmness when you trade the market, because it's like, okay, this is what I have to do. This is like, if I don't see any of these things, I'm not getting in. It's that simple. Like, why would I get in if I don't see any of these things? You know what I mean? Like you got another one, like trend line. Or trend line break, counter trend line. You know what I mean? Like there's really so many things that you can see, break of structure. Like I gotta see 3 of these things, like for me to get in a trade. Like if I want to sell this right now, I can't sell it right now because I don't have 3 reasons. But if price were to break here, I could easily say right now, I will only trade if, and I need 3 of these things. One, price would break out of here. And if it breaks out of here, guess what it has to do? It has to retest. And then it has to come back down. So my first thing I could say is, for this right here, I could say, move over. I could say, price broke through key, I'll say area instead of level. Broke through key area. Price bounced off or is aligned with the trend line. Because as you can see right here, this would have been a bounce of the trend line. Like if we drag this down, it clearly would have been a bounce. Like boom, 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 a bounce off of it. So boom, boom, boom. Like you gotta, predict the future movements of this market. Follow the trend line. And chances are, more than not, you can't see it right now because the moving average is only right here, but chances are not, it's still below the MAs. Chances are not, it probably created like a Marubozu, came up here, created a doji or evening star and dropped. So I saw a nice candlestick formation. Like, you know what I mean? There's so many different things that, like you got to have reasons to get in a trade, which is why you got to have your trading plan concise. So like when you lose, you're like, okay, damn, like did I not follow my trading plan? Did I not listen to all three things? Did I do something wrong? Like what did I do? And you can assess what you did wrong because like I said, you should only have, this is me coming off the cuff. Like this, I probably have a lot more than just these, but these are like just me coming off the cuff, just making a video for you guys and let you know that you gotta have a trading plan and say, okay, I'm only gonna trade if I see these things. Or trading plan doesn't necessarily mean getting in. It also means, I'm only trading between the hours of like 6 a.m. and 10 a.m. or, 12 a.m. through 8 a.m. sporadically or radically. You know what I mean? Like that's a trading plan is your plan to trade. It doesn't necessarily mean how and why you get in. It just means everything in general. Like, what is your trading plan? I'm only trading between this hours. This is what will make me get in. This is what my extension would be. My trading plan is also saying I will never move my stop loss further. I will trust my analysis. Like, give yourself written consent. Give yourself, like, stuff you can look at, like a plan, like some goals that says, hey, this is what I'm going to do. So you know that, hey, if you lose a trade, you can look back at here and say, did I do something wrong? If you win a trade, you can say, hey, my trading plan works. And you can help other people and say, hey, here's my trading plan. You can see if it works for you. Now, as far as maintaining a live trade, what I need you guys to do is to be confident and comfortable. So for me, if I'm trading this pair right here exactly, my take profit, if price were to break through here, would be here. Somewhere between this area, because we got this whole wick all right here, all through here. So price sort of come down here and come up here. I see, a candlestick right here. I'm getting in right here. Right here at the top. Take profit is in there. Stop loss is right above there. A tight stop loss. And guess what? If price goes right here and then tries to come back up, I'm staying in until I see a clear reversal in the other direction, a clear break of this trend line, a clear, it pops its head up above the moving average. But until then, I'm letting it play out. What you guys got to do when you're in a live trade is walk away. Have your stop loss and take profit set so you're not, being risky. You set your targets and your goals. Now you just watch it play out. You know what I mean? Same with here. If for some reason I'm like, okay, like I potentially see a Fibonacci from here to here, price should get to 192, 193 area. Obviously, this is a wick over here, so it could be somewhere around this area, right? It's Fibonacci. And if price wants to, if price is right here, is doji in it, and it's coming down, guess what I'm not doing? I'm not getting out the trade. Long position. If I say I got in like right here, my take profit was way up here based on that Fibonacci. Stop loss right there. Guess what? I'm not getting out the trade. I'm gonna wait for it to create a lower high, then head back up. Then I'm gonna move my stop loss all the way under here. So my stop loss is way in profit. But neither here nor there, I'm not moving it. I'm trusting my analysis. I'm trusting that price is not going to break this key area of 190 and head back down. I'm trusting this area is going to be respected and hold firm. And I'm betting that it's going to turn around and head up there. And I can use this area to scale in and getting another trade. And now I have two trades going to my take profit way up here. When you maintain this trade, this is what you should be doing. Write it down. During live trades. 1, walk away. 2, have fun doing other things. Don't even think about it. 3, when you do think about it, check on the market. See how you're doing. That's all. Just check on it. See how you're doing. Because when you see it, when you check on it, you see how you're doing, and price makes a lower high or higher low, then maybe you'll be able to move your stop loss in profit. We don't ever want to move our stop loss further to make a bigger stop loss. We always want to move it in profit. Move your stop loss in profit or break even when price is moving a substantial amount. Let me check on the market. 4, go back to what you were doing. And if you're still in the trade during like your trading plan hours where you said you'll trade during these hours, then look for another trade, because this one is already in profit. Like, you should at least understand, like, during live trades, you maintain your trades this way, because if you stay here and watch your live trade, you watch it go from 100 to 200, back to 150, back to 100, back to 300, back to $50, you're going to close eventually because you're tired of seeing the fluctuations. When you're not even looking at it, you're just letting price play out, and then you get your phone back, and you're like, oh, price moved a lot, can't retrace a little bit, moved a lot, retrace, moved a lot, but guess what? It's slowly getting to my profit. Like, you know what I mean? It's slowly getting there. So that's what you got to understand. Like, have a good trading plan that you feel is solid and that you tested and tried. But also, you know, when you maintain a live trade, like, this is very like psychological. Like, don't try to get out too early unless, like I said, unless you see a clear reversal, or if price is like so close to your take profit, but it just missed it by 2 pips or like 10 pips. Then just take the profit. Just manually close it, because it's like, all right, like, it was 10 pips away from my take profit. It is what it is. Like, if my take profit was like right here, 196, this area right here, 196, right? And it got right here. The minute I saw this doji right here, that would have caused some indecision and doubt a little bit in my mind, because I'm paying attention to the candlesticks. I would have closed right there. Why? Because this is so close to my take profit. I am only 195.253. Well, this is a big pair. Like, this is a daily candlestick. But if this was on a 15 minute or 30 minute, it would show that I'm not that far from my take profit. I could just take it. You know what I mean? Like, just manually close it. I'm cool with the money I made up here, like from this big move up here. I'm cool with that. You know what I mean? So that's what you got to understand. Be okay with manually closing if you're close, but don't, you know, watch it go up halfway and then come back down and manually close. You didn't even let the trade like breathe out. Now, if it's, let me see over here. Let me brush that. Like, don't do this and it's coming down. And you're like, okay, now I don't want to like get in. I mean, now I want to get out because it's going back down. No, it's just retracing. Relax. You know what I mean? Because if you want to be technical, look at this Fibonacci. Boom, boom, and price is going to reverse and come back up. Don't do that. What you can do is, in terms of, you know, manually closing, is if it, you know, goes up and your take profit comes down, up, down, and you see how close it is, and boom, this touched it, but I didn't mean for it to touch it. I meant for it to be like, you know, boom, 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 like just, you know, just a little bit, and boom, and you can see clear as day that, okay, it got this close. I'm just gonna manually close, and you can see clear as day that, you know, let's just slowly get this drawing tool on. Look at this, shoulder, head, shoulder. We got a head and shoulders pattern right here. So what does that do? That means it's going down. You could have obviously got out right here as well. Like, be very keen and aware to reversal patterns. Like I said, you got to understand the difference between retracement and reversal. Once you understand that, it's easy to understand when to get out, when not to get out. And that's one of the most important things you need to understand when you're maintaining a live trade. So I hope that helped you guys a lot. And I can't wait to see you guys in action, actually implement some of these things.
Guys, gang, what's up? All right, so right now, what you guys may not notice is that a lot of these currency pairs move the same. You know, they kind of have the same, you know, values, the same news moving it, the same technical analysis. And it's not like, oh, all GBP pairs move the same. And all, no, it's not how it is. But what it is some of these pairs, like I said, are correlated, and whether it's inversely or together. So what I mean by that is, if one pair moves up, another pair may move exactly down. Or if one pair moves up, another pair may move up just like it, because they're correlated. I'm going to write out a couple. What I'm going to do is I'm going to Google, like, you know, currencies correlation, whatever the case may be. And you can see which currencies are correlated. You know what I mean? But I kind of already know. So I know with gold and the United States dollar, it's an inverse correlation. So when gold moves up, more than likely the United States dollar will move down. Hold
I can see right here, text. So when gold moves up, USD moves down. Gold is a safe haven for United States dollars. So when United States dollars is in turmoil, obviously, the value of gold moves up because that was the only thing that was backing the U.S. dollar, and before Nixon took us off, and we don't have that no more. So since it's the only safe haven, or one of the only safe havens we have, obviously when the United States dollar is in turmoil, obviously the price and the value of gold moves up, and vice versa. When we have when our economy is doing well and businesses are booming, the United States and the market is doing great, the value and the price of gold isn't the same as much anymore. So that's one of them. Another one would be Euro USD and the Swiss franc. So Euro USD, this is entirely correlated with the Swiss franc. So when Euro is going down, the Swiss franc should be heading up. Let's look at this first for a fact. We don't need any of these. We just need actual correlation. So you guys, hopefully they have it on Google Images to make it easier for you guys. Yeah, right here, perfect, boom. So you guys can save this, on your phone. What it says is it shows you, these aren't really the ones you gotta pay attention to, but it'll show you right now. For example, if Euro USD is going up and USD JPY is going up, then Euro JPY should be going up because Euro, you got to go off the first pair. So, Euro is going up. And since this is going up, the United States, that means Japan is going down. So if you put Euro JPY together, that pair has to go up. And so forth, so on and so forth with all those, the other pairs like this. That's something to keep in mind. Aussie dollar and gold, that's another one to have. Where's it at? Right here. So I think Aussie dollar is obviously Australia. I think they're the third or the fifth largest gold miner on planet Earth. So obviously when gold moves up, Aussie dollar should be moving up as well. So I can write it all right here. When gold moves up, USD moves down. When gold moves up, Australia moves up. So obviously if gold moving up, then Aussie dollar should be heading up as well. So if gold moves up, then AUD USD should head up. And should is a keyword because sometimes it doesn't go by that, but it should head up because obviously if gold moves up and Australia, they both move together, this should move up. And if USD moves down, it's a clear correlation because Aussie is moving up, the USD is moving down. So it should head up, but more times than not, right now it's consolidating. So Aussie dollar is not really known really what it wants to do. If we head to the weekly, you can see clearly how, a little bit how it pushed up. Not as much as it, but you see pushed up a little bit. Aussie dollar pushed up a little bit. Now it's heading down. Now gold is consolidating. Like I said, these pairs tend to move the same, but like I said, some of them are 90% correlated, 80% correlated. Some are 100% correlated. Like I said, some are inversely, and inversely is obviously the opposite. So, when gold moves up, USD moves down. The USD, the dollar index, moves in unison, obviously, with all USD pairs. Moves up, USD moves up. If you type the DXY on here, which is the dollar index, it obviously shows the value of the dollar and what it really is. If this moves up, obviously most, damn near all US pairs should be heading up as well, following order and following suit. You got USD CAD, obviously it's heading up now because the dollar index is heading up. So mostly all US pairs should be heading up following the dollar, because this is not a currency pair. This is not paired next thing. This is just the US dollar, the economy as a whole. Boom, that's all it is. So more times than not, I'll use the dollar index as a guidance to see what, all these pairs really want to do. Obviously the dollar index is heading up, so gold is consolidating, doesn't really know what it wants to do at the moment right now. So I can put, obviously the dollar index moves up. I know Euro USD moves up. Swiss franc, so USD, CHF moves down. So it's just stuff like that, a lot of your stuff, kind of moves the same. I'm not going to get into, your brain about every single correlation, but obviously feel free to go on Google, type currency correlation. These are the main ones you need to know. A lot of the other ones like foreign and exotic pairs, but these are the main ones you need to know. Gold, the US dollar, Australia, the euro market, those type of markets are the ones you need to know. Obviously it's right here. Obviously positive correlation with gold because of the mining operation. Oh, Canada. So oil in Canada. So I think Canada's the third largest exporter in oil, I believe. So when oil moves up, Canada moves up. Oh my gosh. So if you go to US oil right here, you can see, more times than not, like I said, it's consolidating. So US oil is consolidating. So that means USD CAD should be consolidating as well. Same thing, it's consolidating. You know what I mean? So a lot of these pairs tend to do the same thing. And when you see something happen on one end, you can kind of go to the other one and kind of gauge it. But like I said, always remember, it does not have to always follow, but always use it as a guide and the extra confluence on top of the support and resistance and the key levels, the Fibonacci, the trend lines, the Japanese candlesticks. Use all of that with the currency correlation to decide, okay, this pair is going to head up or this pair is going to head down. So I hope that helped you guys a lot. Definitely using your trading because it definitely, helps me a lot. And your take profits, gang, what up? You guys gotta understand how important this is, because setting your stop loss and take profit is the difference of you making a lot of money and you losing a lot of money. Your risk, how much you can handle, and placing them accurately is key. Is probably the biggest thing in Forex, because you have to place it to give your trade some room to breathe. Because price always retraces. Keep that in your mind. Price will always retrace. It'll never go straight down. Price can easily come back up here. And if your take profit is up here, guess what? It just stops you out, but it's still headed down, and the overall trend is to head down. So this video is to help you figure out where to place your stop loss and take profit, so price will never ever retrace there. If price retraces there, then that means the trend is over. It's going the other direction. It's not a retracement. It's a reversal, and you can live with that. So if I was trading a pair such as, let's say, GBP AUD, I like using GBP AUD as an example. That's the week. I don't need to go that far at all. I will take a 4-hour, a Mezio 4-hour. So let me go to a blank chart actually. I like GBP AUD anyway, but right now, let's look at it right now. So let's do our take profits first. So you got to make, first of all, like I said, before you do anything on a chart, on a blank chart, you have to have your key levels there. You got to know exactly where it stops at. I know 190 is a key level. I know that just from obviously trading as much as I've been trading. So I know that for a fact. So keep one there. For me, I have 19 as a key level. I have 195 as a key level way up here, but we don't need it because it's not up here. But I also have 192,500. Price did not go up there. So right now, I'm just going to keep this one area right now. And if it decides to go back up, I'll place 92,500 because that's the midpoint of 190 and 195. So right now, this is this is obviously would be our overall, weekly and monthly, what's it called? Monthly resistance. So if I was to trade up here, right, and I have this little area right here, you either draw like a nice little box up here. I'll probably, make it liquidity or grayed out level. I made it grayed out level. So we have it up here, right? Just showing. If the price is up here right now, we see 1, 2, 3, 4, 5, 6, 7, 8, 9 bounces to the top, right? And it comes back down. This candle right here shows us, like I said, you have to pay special attention to these candlesticks because they tell you everything. This is a shooting star. All of these are doji and indecision candles. It's a big wick on the bottom, big wick on the top, small wick, small. Like, it's not in any direction. This right here is the first candle we got in one direction that says, hey, price is heading to the downside. So if we were to get in right here, actually forget the take profit. First, let's do stop loss since it's going order. So let's say we got in right here, right? This is our area. Now, if we were executing on a 4-hour time frame, unfortunately our stop loss would have to be up here because this is the last high it went to before heading down. So this would be your take profit. So if price were to ever retrace, you'll still be in the trade because your stop loss is way up here. Now you want to have tight stop losses, of course, but you also have to give your trade some room to breathe. Now I'll scale down to like the 1 hour in the section to give you like a real stop loss, but this is definitely a real stop loss if you were to trade longer and longer and have a bigger take profit. Like I said, depending on your risk reward management. Sorry. So what that means is your stop loss would have been up here. So if it were to trace, it won't hit here. And if it does hit here, guess what? It's a reversal and price should be heading to the sky. But obviously it has not touched any of these. This does not touch up here. So you just want to place it just a little bit above it so you give your trade some room to breathe. And obviously, you get in, you would be selling. You'd be selling right here. And your stop loss is up here. Now your stop loss is way above your take profit. So, I mean, your risk is more than your reward. So this trade would have only been, a trade I would have taken if my take profit was way down here, which it probably would have been because, like I said, this was the last point it went to before heading up. Like, you see nothing but blue candles. This is the last point it went to before heading up. My take profit would have been right there. And guess what? Price went all the way down here, and then it headed back up. So it would have been a perfect trade. It's a 2-to-1 or 1-to-2 risk-reward ratio. Now, if you want something tighter, you just scale down to 1 hour to 2 hour, go right back to where you were, and it's easy. So now we got the same point where price is way up here. Now your stop loss don't got to be way up here anymore. Your stop loss can be, well, on a 1 hour, since it's like this type of thing, unfortunately, your stop loss, there's no way around it. Your stop loss will have to be up here. Let's see what a 15-minute candle shows. Yeah, so it seems like it was something real dramatic that forced it all down here. No matter what, your stop loss would have had to been up there. I'll show you guys other examples where you could have got a tight stop loss, but no matter what, your stop loss would have had to been up here. Now, your take profit had to be down here. If this was a trade where you only thought it was going to here, you can't take it because your stop loss would have been higher than your take profit, and it wouldn't have been a trade worthwhile. But since your take profit would have been down here because it's the last point it went to before going up, then it would have been a good trade to trade. So what you guys got to know is that right here, your stop loss should be above or below the last swing high or low. Which means if you're trading, if you're getting in right here, this is the last high it went to. So this should be your stop loss. If you're trading right here and you're buying, this is the last low it was at. So you place it right below here. It's that simple. Like you really just place it, you give it some breathing room. So obviously when it retraced back down here, guess what? It did not touch it. So guess who's still in the trade? You are. So now then it pushed back up. So just place it above the last swing high, swing low. Your take profit should be placed at key levels, which is like the 1.90 level, but also, the last swing high or low before the big push. Does that make sense? So like this right here, this is the last swing before the huge push. So since it's coming back down, this would be a take profit. This would be a take profit. Boom. Another one would be a trend line. Trend line bounces. What I mean by trend line bounces, I mean, let's go to a place where I know it's a trend line. Euro USD. Perfect. Euro USD perfectly. If I was trading Euro USD, let's look at it perfectly. It broke this. It broke this. So where would our take profit be? 110, obviously, because this is a key level. But it's also with the second bounce on the trend line. So you want to place your stop loss around this area because if price 1, 2, basically 3 bounces, if it breaks it, guess what? It has to fulfill all those bounces. So now it has to come down, take profit here, come down, and obviously come here at some point. So a take profit would be, if I would be selling this, if I were to get in like up here after this moving average, say for instance, if I got in right up here on the Fibonacci, which obviously this was boom and boom, 50 bounce. If I got in right here at this bounce, stop loss would have been up here. Actually, it would have been up here because it's the last high I went to, right? My take profit would have been 190. Obviously, the 27 extension is there, Fibonacci extension, but knowing me and knowing the market, I would have put it at the key level. It's going to get there. Cool, boom. Now, if I were to get in again, exactly where it's at right now, like if I were, stop loss would be up here. This is the last high I went to before heading down. Take profit would be all the way down here. Boom. This is point 1. Point 1 on the trend line, point 2, point 3. Now it's coming back down, point 3, point 2, point 1. So that's what I mean when I say, I think it was Aussie I was at, or GA. That's what I mean when I say, if I can find it, is it still, other chart. There you go. So trend line bounces as well. Also, take profits can be placed at fib extension. So that negative 27 extension right there as well. So it's really that simple. Your stop loss should always be placed with the last swing high, swing low. And the take profit can be placed at key levels like here. The trend line bounces when it breaks the trend line like you saw. The last swing high or low before the big push like this. Fib extension, like there's so many different ways to take profit. So right now, for example, let's find another trade. So I can give you guys an example like where my stop loss and all that stuff would be. So go to Euro, like it was just at. I actually kind of just told you guys about this, but for F's sake, if I were to get in right here, my stop loss would have been up here because it's the last high it went to. So it don't got to be way up here. Just be right down here. Take profit would have been here as my first one and the second one. And you can obviously scale in and out. And I'll talk about scaling in and out in my next video, which means getting in more trades than just one. But yeah, that's basically where you just take you put your stop loss and take profit. Some people want to have the tightest stop losses, and that's how they lose money. And that's how they get mad because look at this. This is oil right now. So if I were to get in oil and buy it right here, or let's say right here I got in, right? This is a situation where I can have a tight stop loss. I could put it right here because it's the last low it went to before heading up. My take profit could be this trend line bounce right here, right? We got 0.1, 0.2, 0.3. It's coming back up 3. Now 0.2, the first take profit area. And if it wants to keep pushing up, then we go all the way to 0.1. But right now, this is our take profit, 0.2. This is our stop loss. So it'd have been put a little bit of space between these area. But yeah, so it won't come back down all the way in here. Now, if it does, obviously a stop loss could have been a more, what do I say? If you can handle the risk more and do a smaller lot size, or if your account can handle it, obviously a real stop loss would have been up here because you know for a fact it will not get back down here unless it goes straight down here. Price still can fake us out and want to, you know, come down here. Let's say if you had like that same stop loss, right? So we had the same thing. If price wanted to, because the price can do it, market can do whatever the hell they want, it can come back down, take us out, rebounds off this key area, this key level. Remember, key levels are way more important than where these stop loss levels and these last swing high and swing lows. The key levels are the most important thing on the chart. Come right back to the key level and then shoot all the way back up. What would be the point of that? Because if it comes down here, it gets all the traders out and stops them out, but it also creates inverted head and shoulders, or head and shoulders in general. I don't know if it's inverted. I think it's inverted. Yeah, I forgot my Japanese candlesticks, inverted head and shoulders. Yeah, see, it creates an inverted head and shoulders. Left, head, right, and then it pushes up. So left, head, right, and then it could push up. Like the market can do it at once. You just got to have a keen eye to what the market is doing and kind of predict it. That's all we're doing. We're just predicting. Let me put that back on, actually. We're just predicting what the market would do. But back to my original point about losing money. Most people want to trade, have the tightest stop loss ever. Like they'll trade on a 2-hour time frame. And like I said, they'll buy right. Let me find a pair that's like UCAD actually, right? So people want to trade, right? And if they would have traded right here and sold it, sold, it got up. Their stop loss originally for that trade should be where? Up here. This is the last high I went to. So it should be up here. So if you got in right here, this is a pretty decent pretty decent trade. You just sold it right here after this pair. Boom. Got it all the way down. Take profit at the next, what is it? The next freaking range, because it's in a range right now. And you sold it, and boom, guess what? It came down, up. You're still in the trade because it never got you out, and then came back down again. And you can obviously manually take profit. The problem is some people want to do this, let it come down a little bit, and put their take profit, their stop loss in the middle of nowhere, like or right here somewhere, like within the range. It breaks out, and then it comes back up. That's what it stops you out, stops you out. Still doesn't touch this stop loss, and then crashes all the way back down. So you got to make sure you have your stop loss in a proper area. Give your trade some room to breathe. Doesn't mean have your stop loss 100 pips away or 40 pips away. No, like you still want to have a tight stop loss and have a sniper entry. Like you want to have a 1 hour and make sure you want to catch this move right here. So when you place your stop loss below here, it's not stressing you as much because guess what? You got in like right here. So wrong one. You got in right here. So now you have this huge take profit and a tight stop loss, which is great. But the problem in the play, people enter too late and they enter right here, and now their stop loss has to be way down here because that's the last swing low, swing high, swing low in this case. You gotta have your take profit just so it can get to 1, just to get, I guess you're reaching right now, but you gotta just to get it to a 1-to-1 risk reward ratio. So just make sure you have a good stop loss and a good take profit. Let your trade breathe. Don't be scared to lower your lot size to have a more smoother trade. And if your account can handle it, then make sure you have a good stop loss and take profit so you're able to trade manageably Because the worst thing that could happen is you call a trade out, you say it's going to go down, and it goes down, but it comes up and it stops you out and gets you out the trade because you didn't put your stop loss in the right place, and then it goes all the way down in your direction. You just missed out on $3,000, $5,000 because you didn't put your stop loss in the right place or your take profit. You know what I mean? So make sure you understand that, keep that in your brain, and I'll see you guys in the next video.
Cool. We are officially done with Series 3. That means you've been through Series 1 and 2, and now 3. I hope you guys gained a lot of knowledge in psychology, more in risk management. You understand what swing trading is and how you can use it to your advantage. Scalping as well, if that's your thing, and also more advanced tips on intraday trading. Now it's time to gear up for Series 4. If you think you're ready for Series 4, then you should upgrade. If you don't think you're ready for it just yet, go back, rewatch Series 3, 2, and 1 until you officially feel like, all right, now it's the time. Because you should know that Series 4 is the end-all, be-all. It's the last series. You know what I mean? Like, there's some mini courses as well, but obviously when you have Series 4, you have all the mini courses as well. So if you feel like you want to make that last jump, it's just one more jump. After Series 4, there's no more jump, jump, jump. No, it's the last jump. If you feel like you're ready, go in there. And there we talk a lot about, fundamental analysis. It's like super heavy fundamental analysis, super heavy, bank and institutional trading, super heavy like trading plans and, more psychology and risk management, but on a deeper scale. There is like, drawdown and like, live trading. Like I have some live trades where it's like, I said something was going to happen on Monday, and then I do like a before and after, and then like Wednesday or Thursday, I showed the after effect, whether it was right or wrong. Like I have a lot of that in Series 4. And if you feel like you're ready for that, then go ahead and upgrade. But until then, I appreciate you guys for being in Series 3. I hope it was well worth your time. I don't want to talk for you. I hope it was well worth your time. If there's anything I can do to make the Series 3 better, let me know. But I really, I'm putting, my heart into, Series 1, 2, 3, and 4. And I feel like that's all you need before it's time to go. Like I said it, in Series 4, because I did a little bit of Series 4 before I made this video. I said that after all 4 series, cool, it's time to go. Time to start, actually trading and seeing, implementing the things you learn. So there's one more jump you guys gotta make, and then after that, it is time to get going. It's time to be, right. Series 4 has, brokerage information, leverage and margin on a deeper scale, and of course taxes, so you don't end up like Wesley Snipes or anybody else out here. So I'll holler at you guys. I love you guys, and I will see you in Series 4.